I know everybody says blame it on the Japanese as though they haven't had enough problems, but why is it that in the aftermath of the earthquake in Japan, we're seeing a major sell-off of yen and its broader implications on global markets?
Well, absolutely. I would say the events in Japan have led to a rise in general of risk aversion, and everybody's obviously very concerned about what this means for the global economy and the recovery path of all the advanced economies. And it's also had obviously an impact on the demand for risky assets, so amongst others commodities. So we have seen an impact on the yen, obviously, which has been strengthening on the back that the expectations were that a lot of investors would be returning their assets to Japan in order to bring the liquidity home in order to obviously finance some of the rehabilitation process. So we have seen that the yen rally. We've obviously seen the intervention by the G7 following that rally. On the African side, obviously, it's also been having an impact through the nature in which risk aversion has impacted the markets. For one, the commodity prices, but also obviously the dynamics between the euro and the dollar.
Some African currencies are significantly depreciated against the euro, and then they've tracked a bit more gains against the dollar. What's that discrepancy?
We've obviously seen a mixed performance against the dollar, while the reaction to the euro has been fairly idiosyncratic. So we've seen a fairly harmonized depreciation against the euro. Obviously, we've seen the euro strengthen across the board, and that's been the main driver along those lines. The reaction or the response that we've seen against the US dollar has been far more mixed. So we've seen a number of currencies actually strengthen over the past weeks, while the most notable movements have been on the upward side. And obviously, the Kenyan shilling is one that comes to mind, as well as the Nigerian naira and the Ghanaian cedi. So they've moved quite drastically against the dollar.
Let's break these things down, starting with the Kenyan shilling that you're talking about. I mean, this week it hit some of its lowest levels in recent history, and the central bank was loath to intervene and saying it's all these international exogenous factors. The fundamentals of the shilling are strong. Your views?
Well, it moved to 87, which is the weakest point we've seen the Kenyan shilling in a very long time, and I don't think it's not solely external factors that have been driving that. What we've seen, obviously, is that there's been inflationary pressure building in Kenya, and we've seen the CBK being fairly reluctant to respond to those pressures. So there's been a growing anticipation of how the central bank is obviously going to address those inflationary pressures that we've seen coming through, and their reluctance to do so has been driving sentiment, particularly against the Kenyan shilling. So while we've seen risk aversion globally increasing, we have seen, particularly in Kenya's case, market participants reacting to what they see as benign neglect, basically, of the inflationary pressures, and that would perhaps warrant a tightening of monetary policy.
We've seen the naira breach the 156 naira to the dollar level, and some are saying it has to do with the elections coming up. What's your view?
Well, we saw the same occur in Uganda, the previous elections that were quite notable on the African continent. We saw there the risk appetite declining, and obviously apprehension towards the elections grow. And it's natural, I think, in African markets that there is a level of apprehension in the advent of elections, and in Nigeria's case, it's undoubtedly so that market participants are becoming a little bit apprehensive with potential political risks that might be associated with those elections, and therefore building along US dollar positions, which has to some extent been contributing to the weakness of the naira.
But the upside risks on the naira, very briefly, because the oil price obviously should be supporting that currency, and just attempts at revitalizing the economy, growth prospects looking good. So post-elections, would we see a better picture for the naira?
We're in agreement that there probably will be a post-election rebound, and obviously with liquidity conditions tightening along with monetary policy being tightened and inflation risk there also likely to increase, we're likely to see a rebound after the election. So we saw that briefly in the case of Uganda. Obviously their ongoing political tensions have caused some weakness in the Ugandan shilling, but in Nigeria's case the fundamentals remain strong, and we're likely to see that rebound coming more forcefully through on their side.
The situation in Mauritius?
Well, their currency has actually been strengthening, so it's unlike the two currencies we spoke to previously. We, on the whole, they are of the opinion that there's likely to be a weakening bias moving forward as the central bank seeks to support the external sector. So the strengthening that we've seen recently, we believe that that should come to an end fairly soon.
And very briefly, for those commodities exporters like the Zambia, where the kwacha has been buoyed in many ways by copper prices, any pervasive risks for that currency going forward?
Well, overall, obviously, that's going to tie in with the prospects for global growth. And at present, we believe that the bearish risk sentiment is likely to weigh in on metal prices as well as very many other commodity prices. So that could create some volatility and further upside risks for the Zambian kwacha. But in the long term, as the implications of the Japanese events unfold and becomes clearer how it's going to affect global growth as well as how the rehabilitation of Japan is going to unfold. It could have a upside potential for commodity prices, and therefore we could see the Zambian kwacha rally again.